Today, Aussie housing the weakest in the West. Hello again, it's Martin North from Digital Finance Analytics, working on its post covering finance and property news with a distinctively Australian flavour. And today I'm joined again by Tarek Brooker, journalist. Hello, Tarek.
Hello, Martin. How are you?
Yeah, pretty good. Another Friday afternoon, another time for a chat. And guess what? It's all about housing again, isn't it?
It's everybody's favourite subject these days, isn't it? You know, you've got all the bears and then you've got all the other people who are excited about their, what do they call it? The bear barbecue.
Yes, I can smell the roast bear even as we speak.
Oh, it's something like that, isn't it, mate? You know, it's really quite interesting to see how it's all evolving and all the rhetoric's changing and all that sort of stuff. It's really quite something to watch everyone go from bear, you know, from relatively bearish all the way to bullish. And you know, I'd imagine that as things, you know, perhaps deteriorate, we might see it go all the way back again.
Well, it's interesting. And what's fascinating about that, of course, Christopher Joy wrote his latest piece in the AFR and basically ticked off all of the people who, you know, like CBA and Westpac, who were bearish and now have gone bullish again. And basically he expects everybody else to follow suit. And, of course, all based on the CoreLogic Index, which actually reported lower prices in Sydney and Melbourne and a slight rise in the other centres. But just to make the point, an index is not the same as house prices themselves.
No, and REA made that point to a degree the other day as well. You know, they said that they pointed out that in certain luxury locations, it was rising quite strongly. You know, you're looking at places like Colorado that are up, you know, 5+%, and then there are obviously other places that aren't doing quite so well. So I think that it's really quite something, you know, to say, oh, Sydney housing prices are rising. Well, it's like, okay, they're rising in these luxury suburbs where people have a lot of, you know, sort of capital sitting there or disposable income or whatever you would like to call it. And that's something that we're seeing across the world. You know, you're seeing that in the US, you're seeing that in Canada, the UK, a whole lot of activity in these upper echelons of the market, but not so much down where, you know, the sort of regular everyday people are.
And the point to make there is that the volumes, of course, are still very, very low, way down on what they were previously, which, of course, people forget. The second is that all of the transaction settlement data is delayed by, 3 or 4 months, you know, whatever. So the indices can hardly be reporting the most recent changes. So it could well be actually earlier on. And then, of course, the other question is, well, what other information flows are going in? Well, some of those may well be auction clearance rates, but as you've shown, the proportion of auction clearance rates that are actually not being shown now is higher than it used to be. And generally, there's a lot of silence from many parts of the market. So, you know, in a way, I'm not sure that the story about everything is going up remarkably is really the true story. But, of course, it fits in line with the spruikers, isn't it?
Well, that's something that was really interesting. I was having a conversation with Louis Christopher about that on Twitter yesterday to some sort of degree. And it was interesting because there's the stock on market data that we're seeing from CoreLogic, and then there's the stock on market data that we're seeing from SQM. Now, Louis correctly pointed out that there are likely significant differences in methodology. But the really interesting thing was that the differences were just so huge. And they pointed to two very, very different outcomes. You know, you've got the CoreLogic data that says that we've got the lowest stock on market in years. Years and years and years. You know, the last 5 years, you know, well and truly down over this time of year, even down on the seasonal January and December lows. But SQM's data doesn't show that. SQM's data shows a relatively sort of consistent availability of stock, and not only does it show that, but it also shows a significant number of houses that have been on the market for quite a long time, and you know, especially even in the sort of 180-day plus range. And that doesn't really fit with the message from CoreLogic. I mean, I don't know what the methodological differences are or how exactly they've arrived at that figure. But I mean, personally, I prefer the CoreLogic numbers there because I don't have to pay for them. They're incredibly transparent. There's years and years of data. And that's what I use to base a lot of my various data points that people may see on Twitter. But it doesn't really sort of line up. And I'm also seeing a similar thing in the Domain sales numbers. The Domain sales numbers compared with their previous years are very, very low. Now, I don't have access to the 2019 data, which is an issue because Domain haven't published that. If anyone does have access to that, please leave it in the comments below because I'd love to add to it. But at the moment, we're lower than 2018 volumes, which was when the market was struggling, when volumes had really dropped significantly. And we're sitting about sort of 50%, 55% below the peak in 2015. Now, that doesn't really sound like the sort of super perfect, amazing market that we're hearing about in other places. And as you said, we also have the similar issue with the withheld auction clearance price numbers.
Yeah, and a lot of this is let's understand motivations, right? Let's understand the situation with regards to why would they be wanting to represent the property market as really bullish rather than bearish. And there is a psychological aspect to the markets, right? So the more people hear that everything's going really well, the more likely is they might go and do things, which means that it becomes self-fulfilling. I use the analogy of the chartists. The chartists plot the movements of stocks and basically make predictions about what's going to happen next. And the interesting question then is, to what extent do those chartists actually then become self-fulfilling? Because by definition, if enough people believe it, it happens. There's a bit of that going on at the moment, it seems to me. And my own perspective is that we need to be quite cautious about some of these, because clearly transaction throughput and numbers of searches, all of those things generate revenue for a lot of these organizations. Plus, of course, the fact that sales themselves will generate commissions for the industry. And then, of course, there's also the broader issue of everybody's wanting to talk the economy up because it's so weak. All of those factors are in there. And I just think that maybe we're not getting the full picture. My own data is quite interesting too, insofar that there are some postcodes where prices are definitely higher. There's no doubt about that. But that's the exception rather than rule. I can see big gaps and differences between units and houses. And I'm seeing very big differences even in relatively close together postcodes. So this is a real big patchwork at the moment. And I don't think that anybody who takes the Sydney average and therefore makes a decision on the Sydney average is doing themselves any great service at all. I think they have to go granular, get into more detail. And I also make the point again that a lot of the settlement data is being withheld. That settlement data won't come through for some time yet. And when it does come through, it may well change the story. One interesting observation is I wonder to what extent the indices are back changed once the settlement data is loaded. I don't see much evidence of that.
Yeah, I'm actually quite curious just to hear about some of the things in your own data, just in the sense that, I'm seeing this relative lack of sales, and lack of turnover. And I'm just curious, are you also seeing that in your data? Just, is transaction volumes low?
Yes, I think the transaction volumes are very low, and your point about a lot of stock on market for a long time is dead right. So there are some new properties that are coming on and are quite attractive properties and actually attract quite a lot of interest. In some cases are over the reserve price if they've gone to auction. But then there are lots and lots of properties that have been on the market on and off for 6 months or more, and they're still hanging around. And in fact, it's the marginal ones that are actually transacting, but it's really, really low volumes. And that's actually confirmed by, if you look at the ABS statistics, who actually does show the settlement data, okay, it's 5 months out of date, so it's not the latest, but that also shows the same trend of falling data. So it's more about, I think, the fact that things are on the slide in terms of transaction throughput. And it's interesting, I was talking to Edwin on Monday, and he was expecting a higher listing rate than he's currently seeing, although he did actually make the comment that there's a bit more evidence now of more listings coming on. And the other interesting thing about my survey is that quite a few people who were thinking of listing this side of Christmas are now saying, well, maybe I should just wait and see how this all plays out. So that's true of property investors, and also true of people who are looking perhaps to downtrade and sell to release equity. So there is also a little bit of uncertainty driving some behavior where people are preferring to sort of go into a holding pattern and just wait to see what happens. So I think all of those factors are in the mix. And then, of course, you have to separate the different geographies, because if you look, for example, at Melbourne, clearly the prices in Melbourne are significantly depressed and the transaction volumes are relatively low, whereas in some other locations, for example, if I look at Tasmania or South Australia, or indeed some areas of Sydney, it's a bit stronger. By the way, Brisbane is not looking particularly flash at all, despite what all of the spruikers have been saying about Brisbane. And I've been watching prices there are definitely on the slide. And again, I make the point, units are behaving very differently from houses. And there are significant differences across Queensland between the areas around Brisbane and further north up around Cairns and around there. So I think, again, people should be cautious and careful and just not be swept away with these high-level enthusiastic statements about what's going on.
I've done a little bit of research myself into I'm trying to find the rough sort of balance between the stock on market and the amount of transaction volumes that are actually occurring. And I found that even if you look at places that are absolutely booming, places like the Sunshine Coast, places like the Gold Coast, which are doing very, very well relative to the rest of the country in terms of relative turnover, when you actually go back and look at relative turnover compared with previous years, it's not that flash. It's not that impressive. And I mean, I've only done a very preliminary analysis, but it's still not looking as sort of amazing as people would suggest. But I think that that's just because what we're seeing is this lack of what would you call it, desirable supply in some of these places. And especially in places like Queensland, you do have that, as Edwin mentioned on Monday, the buyers going north from Victoria or from New South Wales since the crisis began and, buying sight unseen.
Yeah, that is definitely one of the things that's coming through in my data. And, people are thinking maybe of moving from Melbourne up to the Gold Coast and places like that. By the way, I would tell you that the volumes may be slightly up in Sunshine Coast and Gold Coast, but the prices are not necessarily religiously following that. So there are examples of prices that are actually considerably better, but there are also a number of prices that look to me to be quite weak relative to where they were previously. And again, you have to go location, and also type of property by type of property to really understand what's going on. I also note the old hot chestnut, but it's quite important that there is a very small number of very expensive properties that continue to sell and sell at wacky prices. But that, it doesn't, one swallow doesn't make a summer, right? I mean, you're always going to find those more expensive property prices will be met simply by people who don't need to borrow and can buy at any price. That's just the nature of that end of the property. But you can't extrapolate the whole property market from what's going up there in the the very end, as it were, the very top of the market, the 1 or 2%. You've got to look at the volume size and the shape of the pool of transactions overall to make any sense. And I have a feeling that because of the low volumes and because of the distortions, some of the things that people are claiming may not be true. And of course, some of Christopher Joy's arguments are actually simply about the fact that with the loosening of credit standards, that's going to actually allow people to borrow even more. And Stephen Muckleburgh over at CanStar basically calculated that there was a big lump coming to lift prices. I'm just not quite so sure about that. Looking at the lending standards more recently, a lot of people have been quite able to get the loans they wanted already. So I'm not sure it's necessarily going to open the door to, massive volumes. There may be some, but I think it's going to be at the margin. And I suspect also that it rather depends on what happens from this point onwards with regard to prices. If we do see prices rising, and if the economy comes into back into force much quicker than we both expect, then that may have an impact. But of course, you've got to have the broader perspective with regard to the stimulus being removed and the loans that are currently parked going to have to be activated. And the APRA data was also quite interesting when that came out this week, just showing that there'd been very little decline in those postponed loans at the moment.
Exactly. I mean, realistically, Anna Bligh, who's the head of the Australian Banking Association, or their spokesperson, I forget exactly which one, she came out earlier in September and she said that over September they're going to be contacting 400,000 borrowers, and that's basically determining can they resume paying their loans. And when we do get the data for September from APRA, that is going to be the big test. Because if we don't see a very, very significant drop in the amount of deferred loans after the bank has gone through and contacted 400,000 of the roughly 400,000 people who are still deferring their mortgages and their small business loans, it's going to get really, really interesting, because that's going to signal to the market and to everyone else that perhaps these people aren't going to repay their loans. perhaps things are a little bit more difficult than the rosy narratives would suggest. And then things start to get really, really interesting. And I think the thing is, I mean, just looking at the market more broadly, like, you're absolutely right. If we are wrong, which, let's face it, is always possible, and then sure, the cutting of lending, the cutting of the lending standards could drive prices higher. Absolutely, it's certainly possible, and I've discussed that with quite a few people. But by the same token, in my discussions I've had with reps of the banks, when we've discussed things, say like the government-backed small business loans, they're not that keen on taking risks where they don't think there's going to be a significant payoff. And they didn't find a significant payoff even when the government was willing to backstop 50% of the losses. So they're going to want the economy to be pretty solid before they do this. Now, if we're wrong, if we get a vaccine and everything recovers really, really quickly, and somehow that happens, then yeah, sure, prices can rise. Prices can probably go up 10 or 15%. And yeah, they can be right. But the problem is what if the economy doesn't recover very well? What if the sort of more, like, I mean, I'm not sure if you saw it, but that report from the 730 report the other day, which I thought was fantastic. Perhaps you could link that in the description, because I think every Australian should watch that. And it really does speak to the problems that we may face. And if that scenario is the one that's realised, then the banks aren't going to turn around and they're not going to open the taps, I don't think. I think they're much, much more likely to be cautious and to be prudent, because they don't want to go out and act irresponsibly only to have the loan in default, or sorry, not every loan, but a significant number of the loans they're writing in default, not that far down the road. And they're not stupid people. They at the end of the day, they want to make money for themselves and they want to make money for their shareholders. And from my discussions with them, it's all about the best, safest way to make a buck.
No, good point. And it's interesting because the analysis that I've done of loans that are actually in the park mode at the moment, and there are some, around 25% will be fine. They'll be able to come back, because quite a few people took those loan repayment holidays when they didn't really need to. They just sort of took the opportunity to stop making loan repayments and create a bit more savings and things. At the other end of the spectrum, there's about 25% who are really in deep difficulty and whose income has fundamentally and radically changed from where it was and is unlikely to come back. Now, some of those will get postponed a bit longer, up till March next year, and APRA has basically allowed the banks to reset the clock, as it were, if in fact they do a review and they find they need to postpone again. So that can run until March. And then you've got the chunk in the middle, 50% of the people who've got some change to their income but can still make some repayments, and there the options are probably interest-only loans or the restructuring of the loans or extending the loans further, those sorts of things. But even that 25%, if that's roughly right, it's a quarter of the outstanding loans, that's enough to make a big dent if in fact some of them go wrong later. And the other thing is, I've had 4 people now so far send me copies of the letters they've received from the banks, all saying, we're going to actually ask you please to put your property on the market, in dressed up words, but that's what they've basically said. So it's not moving them into default phase, but it's basically saying that as a result of the review, we think that that's the best strategy for you. So they're starting to put pressure on some people in terms of being able to make those repayments and essentially see this through. Now, that's going to take some time to work through, as I think we discussed in one of our previous shows. This isn't going to sort of all pop over in just a few months. This is going to grind on for quite some time. If you go through the process of actually working with a customer and ultimately decide that you have to foreclose, that's 6 to 12 months down the track. So this isn't necessarily going to be something which is going to be, hitting immediately. And so it does come back to scenarios, right? And I'm going to make a plug here. So next Tuesday, I'll be updating my mortgage stress scenarios and the September scenarios. I've actually updated the scenarios to take account of what we now think is going to happen with regards to those changed instructions from the regulators. In other words, you lose ASIC's control over responsible lending. And so I'll be discussing that on Tuesday, 8 p.m. Sydney. I'll put a link below. It might be worth people tuning in for that, because I think it'll be an interesting discussion. I've been quite surprised about the impact this has on the overall trajectory in terms of prices and also in terms of losses. But nevertheless, it doesn't fundamentally turn the market around completely. And I think that's the key point. These are probably changes at the margin, and I do think the broader economic questions and the unemployment questions, and frankly the other budget stimulus that we'll get on Tuesday, will actually perhaps have a bigger impact. And don't know whether you saw, but UBS actually also published some information today on a sort of comparative basis, and we've actually slid down the list in terms of being the least affordable relative to some other countries, which of course is a reflection of partly the weakness we had over the last couple of years, but also the fact that prices are strong in other places. In fact, the title of this show was we're a bit down the list right now, so that's something else just to bear in mind with what's going on.
That's something I've been meaning to ask you for the last few weeks, actually, since we last spoke. I'm actually quite curious as to, why do you think that of all the places in the world, given our sort of heavy addiction to property, that we have the weakest housing market in the Anglosphere?
Oh, I think that's relatively easy to answer, and that is because we had some of the highest debt to start with. So, I mean, only Switzerland has a higher debt to GDP ratio than Australia, and we have the highest debt to income ratios in the world. That's definitely putting a dampener on our ability to be able to run forward. Secondly, of course, we didn't have the price falls that some other countries had. I mean, if you look at the US and Ireland and the UK after the global financial crisis, in some places prices dropped 20, 30, 40%. So they basically dropped back and then started to recover. We never had that fall, partly because interest rates were cut, partly because our economy was perhaps a little bit more supported by China and by the Federal Reserve and all the other things that were done locally, and of course the Rudd stimulus as well. All of those things supported the economy. And so I think we've got a different economic scenario in a different part of the cycle. And the other point, of course, is that actually Australia is still regarded internationally as a relatively strong economy compared with many others, simply because of the issues relating to the resource sector and the fact that we've got very large income coming from our exports. I mean, our exports are still massively high, even if the iron ore price is looking a bit weak. So on a relativity basis, not too bad. And of course, we also had the other factor that their interest rates have been lower for longer, whereas we cut our interest rates more recently. And that's probably another factor in the mix in terms of actually sort of seeing the timing differences.
No, that's something that's really interesting. I mean, I think one of the things that I find sort of interesting from a comparative perspective is Canada. Because Canada has some of the same pressures as us. They've got the issues with immigration, they've got the issues with hot money coming in from Asia and from elsewhere, and they've also got the issues with sort of enormous prices. I mean, Vancouver sort of in a lot of ways makes Sydney look sort of okay. I mean, it's all relative, I suppose, but it does sort of really interest me, the fact that our biggest cities, our most desirable cities, obviously that's a matter of perspective, and Sydney and Melbourne are struggling the most. Yet in Canada, we are seeing this big pickup in housing prices, despite the fact that they're already very high. And not only that, but unlike Australia, Canada has also seen a tightening of credit from the banks, while our tightening of credit has very much been at the margins, sort of tinkering with suburbs here and there, tinkering with LVRs, depending on, COVID-exposed professions, etc. So I really do think that, is there some sort of fundamental psychological difference? Is there something where Australians are just going, it's been pretty good for a pretty long time, I don't know. And I think that's something that's really, 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 really interesting for just from that broader, sort of collective consciousness perspective for the entire country, because, we are seeing this sort of caution. I mean, and as you said with your surveys with people sort of holding off on transacting, holding off on listing, it does make me sort of wonder, what's going to happen when we do finally start to see transaction volumes pick up, turnover pick up. What's going to happen? What's going to happen then? It's a really fascinating question.
Well, it is. And, as with all of these things, there are lots of different moving parts. I mean, I went on Mike Martin's show the other week. Mike Martin is a Canadian. He covers the property market globally as well as in Canada. But he made a couple of really interesting points about, for example, the Vancouver market. So one is there's still a lot of foreign transactions in Canada. They've sort of closed off various sections of some markets, but the money's just gone elsewhere. And the second point he made is that there's been a lot of money laundering, and money laundering through property. And that's been one of the other factors that's been definitely supporting the Canadian market. And he's sort of asking me about money laundering in Australia, to which I replied, well, the truth is that there was several reports issued internationally that said Australia is right at the bottom of the list in terms of dealing with money laundering and real estate, and there's no interest in anybody taking that forward. So you got to try and put all these pieces of the puzzle together. And going back to your point about psychology, there's definitely some psychology in Australia which is very interesting. So I think I may have said this before, but just to repeat, half of the people that I survey still think that there is a 7-year cycle through in which prices always double. That's sort of religious, right? And there's no basis for that. There's no data to point to that. I mean, there might be the odd property, but generally it just hasn't gone like that. But people still believe it. The second is I did some work with Joe Walker, actually, the guy, by the way, who does the podcasts, on housing bubbles and those sorts of things. I'll perhaps put a link below. But Joe Walker and I looked at long-term expectations about home prices in Australia, right? And pretty much to a person, in Australia, most people think prices will be much higher in 10 years' time. So there's this expectation that prices will be higher in the future. There might be a wobble over the next 1 to 2 years, but long term, prices are very much higher ahead. And, the swag man basically made the point, well, that's pretty standard, right, in terms of actually the way that Australia thinks about things. So there's a bunch of psychology, which I think is also quite important here in trying to understand. And I keep coming back to, if you think about, housing bubbles and the way they work, you've got to take account of the economics. So that's, how much can you borrow and what the interest rates are. You've also got to take account of the psychology and the lemmings and, all of the people trying to get on the property ladder and those things. And then you've got to take account of the political overlay and the fact that politics and housing is completely interrelated. And in fact, I think the political dimension is probably stronger here than in many other countries. So all of those factors are working together. And so without understanding the interplay of all of those elements, you're never going to understand what's going on in the property market.
Oh, well, I mean, I think you pointed out, quite correctly that there is this sort of strange intersection of all these various different things here in Australia that you don't see elsewhere. I mean, in the US, it's like, oh, okay, housing prices are going to fall in Louisville, Kentucky, and, by 20 or 30%, people just go, well, who cares? Doesn't really matter. Some of the local banks might get hit, but it's not really that big of a deal. But here in Australia, it's a very, very different story because the housing bubble is the economy, for better or worse, unfortunately. And it really does make one think just about the broader psychology and what it's going to take to sort of shatter that, prices double every 7 years narrative. Is that just going to keep going and going forever and ever? I mean, perhaps it will, I mean, there are still some people in the US who believe, property is fantastic and always has been despite their housing crash. And I don't know, I just think that we aren't going to see a capitulation of the masses until things get bad enough that is finally shattered. And I think that adds a really interesting extra hurdle to our potential housing crash versus all these other countries. Because other countries have had significant downturns, but we haven't. We've had 25, 30 years of woo, prices to the moon. You didn't need to be smart. You didn't need to be talented. All you needed to do was buy a property. I mean, I read this tweet the other day. It said, 90% of millionaires all work hard. And I'm just like, oh, bull. This is Australia. All you need to do is just buy a house in Sydney 15 years ago.
Mm. Well, did you see the report that came out that basically made the point that most people have actually made more money from their property over the life that they've spent in property relative to their total income generated from working? I mean, that's a remarkable statistic, but it seems to be relatively true. Now, the question is, of course, will it be true ahead? Because it's unlikely, I'm still going to stand by this, it's unlikely we're going to see property prices going through to the moon like they did. There might be, some downturn, but then some sideways movement, and maybe later some upward movement. But I don't think we're going to see the same trajectory, bearing in mind that interest rates are already pretty much as low as they're going to go. I mean, okay, the Reserve Bank may cut rates a little bit further ahead. I suppose that's always possible. And, the mortgage rates are definitely getting as low. but there are still some limits to that. And yeah, you can continue to loosen the lending standards, but we're still at 6, 7, 8 times income. I mean, that's a big set of multiples for new borrowing, and that means that there's got to be some limit to how far people can actually literally borrow and how far the banks will lend. So all of those factors together suggest to me that the trajectory ahead is unlikely to be anything like as strong as it was. And then you've got the demographic shifts, as we've discussed previously, with down traders looking to sell, with less property investors and with less international movement because of the borders being shut and because international buyers are not around. You've got to factor all of those elements into the system as well. So it's quite a complex set of different parameters all working together. And then, of course, you've got the geographic overlays, because geographies are not all equal, right? So there's some signs, having seen prices in Perth drop more than 20%, that maybe they'll stabilise a little bit because rentals are a bit tighter now. But if you go out of Perth, very different story there. So you can't just generalise for Perth, neither can you generalise for the other locations too. You actually have to go quite specific. And I guess that's part of my frustration, really, that all of these generic publications that come out on the various portals and in the newspapers, just making these high-level overt statements, are just missing the granularity and criticality of getting into a much more detailed analysis of what's going on, and really trying to get to the point of standing back and being more realistic about what's there on the ground locally. That's the bit that's missing, but of course nobody really wants to talk about that, and that's probably because it would sell less properties.
Well, that's the thing. There has been this sort of collective psychological event that the entirety of society has experienced. And obviously, for people with large amounts of wealth, with large amounts of investments and free cash flow, they're able to go off and do all sorts of things. They're able to go off and buy properties, go buy cars, go buy, paintings or whatever it is. You're seeing growth in all these various different asset classes. But at the end of the day, that's only one part of the economy and one part of the market. And that's what we're seeing in the US. We're seeing it in Canada. We're seeing it in the UK. We're not seeing this, this really, really driven property impulse at the more sort of everyday person level. It's occurring at these very, very high levels, at sort of well above median prices. And I think that's something that's really, really interesting, that's going to be fascinating going forward, to be honest, because we could see this really interesting phenomenon whereby the rich people have all had this sort of collective, let's call it akin to a minor near-death experience, because their priorities have changed, their worldview has changed, but the value that they see in their property due to work from home has changed. But okay, they're going to go off and they're going to go drive up prices in Vaucluse. They're going to go drive them up in Coleroy. They're going to go drive them up in the Blue Mountains, in parts that are attractive to the wealthy. But realistically, I mean, and let's be frank here, that could drive the median CoreLogic Sydney housing price well and truly up if you see sort of inner city areas stagnating. And even if the less desirable parts of Sydney, say on the outer west, the outer southwest, get absolutely smashed. But you're going to have someone reading a newspaper in Liverpool Macca's thinking, oh, housing prices have gone up heaps. And then they look at the local area and they go, why is my house worth 200 grand less?
Well, that is the point, right? So the generic movements in Sydney and Melbourne don't reflect the local situation at all. And the other point to make, of course, if you think about house price growth, people don't account for the transaction cost of buying in the first place. So typically it will be stamp duty and transfer charges, and the cost of carry as well, right? Because inflation's running at 2-3%, whatever it is, it varies over the years. When you put those numbers in as well, then that overall growth range actually is significantly lower. And one of the things I've started to do when I have my conversations one-on-one with people is to show them the post-inflation adjusted returns. And that makes a very interesting and quite different story, right? And despite the fact that, this thing about doubling every 7 years, the truth is it just is very, very unlikely to be true for most people. There'll be a few, but most people won't have anything like that. And if you factor in all the other costs, then actually, in many cases, it's line ball or just slightly above line ball. Now, of course, you buy property, particularly for own occupation, not just for the financial return, but also for somewhere to live, and that's worth just reflecting on for a second, right? Property is more than just an investment. But if you're an investor, then you are making an investment return and an investment calculation, and you should be comparing it with investing in stocks and shares and other asset classes. And when you start doing that and take the full account of all the costs involved, actually property often looks much less favourable than perhaps people would first think.
Well, yeah, I mean, I think that property in Australia has been viewed as a very, very different asset class for years. You know, it's both viewed as an investment, and it's almost viewed as a sort of concrete piece of almost like a precious metal. Just
it's a magic pudding. It's a magic pudding,
right?
Yeah,
exactly. It's a magic
always goes
pudding.
on giving.
Yeah, it only ever goes up in value. Things only ever improve. And that's really the way it's been viewed by a lot of people. You know, I mean, I've spoken to some people who've been looking at some of these investment properties, and oh my God, the yields are awful, the capital gains chances are awful, but still they go, but what if prices really take off? And it's like, no, it's a dog of a property. It's crap. The area's filled with druggies. It's not, you know, and that's not going to change anytime soon in that particular area. You know, sure. Some areas gentrify and improve and change, but that area is not going to improve anytime soon. And your sort of short-term viewpoint on this really doesn't add up. But I think, as you say, property does have value. Sure, it will always have value as a shelter, as your castle. And I think that's something that I really want people to keep in mind in this conversation, is that we have our viewpoint. We have our viewpoint, and yes, that viewpoint is relatively bearish on property. But when it comes to you as an individual, you do your own homework. You look at things for yourself, for your personal situation in terms of your employment, your prospects, your desires, your priorities. And then you look at things and you make your own decision. Because while we have our overall viewpoint, the way things are in your area or in your life might be very different.
Yeah, that's very good advice, Tarek. And, it's one of the things I keep talking to people about, which is get more informed, use multiple sources of information, pull it all together, but do your own calculations. Don't just rely on what the bank says, or don't just rely on what the estate agent says, or even what the property portals say, right? You've got to get a little bit more intelligent than that and really get into some detail. And, some of my conversations, I've done more than 150, I think it is, one-on-one conversations over the last couple of months. It's been very interesting because as I've shown people some of the pitfalls in terms of the information that's there and some of the gaps in the information that's there, you can see the sort of the scales dropping away, and they sort of begin to realize, oh, this is a bit more complicated and a little bit more awkward than I thought it was going to be. And yet most of them are very grateful for the fact that there's actually, greater clarity about the dimensions that should be explored. And I suggest that people should be looking at some of the property calculator, like Nucleus Wealth's property calculator, which is actually a very good calculator, and also look at multiple sources of information. I don't claim to be 100% right, but what I do want people is to be a bit more questioning rather than just swallowing holus bolus what the what the mainstream media is pushing. And remember, of course, that there are agendas out there.
I really do feel for people, to be completely honest with you. I really do, because it's tough. It's tough full disclosure, I don't own a home. I do have investments in certain property infrastructure, full disclosure. But in terms of a home, no, I don't own a home. And that's something that does concern me. I can completely understand why some young people look at something like the $55,000 grant in, total grants in WA, and they go, oh, well, it's a pretty good chunk of a mortgage, I may as well buy. I can completely understand where that fear, where that drive, where that almost primal urge to do so is coming from. And I really think that it's kind of sad that is exploited, that is twisted from something that should be something that should be powerful and almost almost to a degree, a level of care for your family to build a place for them.
You want, and that's
twisted. Yeah, and it's twisted into something horrible.
Yeah,
it's twisted into something that makes people take leave of their senses in some cases, and commit to this 2-minute noodle lifestyle where if the littlest thing goes wrong, they're stuffed. And I mean, I know that that's not everyone, but that does happen. And that to me is just things I shouldn't say on camera. But you know, it is disturbing, you know, and perhaps the most disturbing thing in all of this, not to get too political, is just that this is what the government is basing out the future of our economy on. You know, it's let's slash the lending standards, let's build more houses that we're just going to end up inflating the price of anyway. And that's frankly disappointing, not only as a younger person looking to get into the property market at some point, but also just as an Australian.
Well, I agree. Interestingly, I don't know whether you saw, but one of the Federal Reserve governors made a speech overnight and basically argued for reducing lending standards in the US too. So it's not just us doing that, right? It's much wider. It's all part of this strategy of saying, well, the only way we can make the economy grow is to lend more. If we can lend more and get more people to take bigger loans, then we can keep the economy afloat, and the GDP will look better, and house prices will go up, and that means that there'll be the wealth effect. You know, you can see the argument being built, right? That's a very myopic sort of approach, bearing in mind where we are in terms of our affordability. But the bottom line is this: I don't think you can think of property as just an asset class without understanding the political overlay and understanding the broader agenda that there is in terms of using property and using people to basically support property by, you know, encouraging them to buy, bribing them to buy, I would say, which is what I think is going on at the moment with the first-time home builder grants and those sorts of things. It is a political overlay, and as I may have said before, I'll say it again, no politician will want to see property prices fall on their watch because they know that they will be less popular at the next election. And there is an election just, you know, a few months down the track. So guess what? They're going to throw everything at it, kitchen sink, conservatory, and anything else that's movable to try and keep this show on the road for a bit longer. The question is, at what cost? And my sort of overarching point is this: you can solve housing affordability in two ways. The first way is to allow property prices to come back to closer to long-term averages, and we're 40% over that at the moment. There's a pain involved in that for existing owners, but that would solve housing affordability for new people to come in. The second way of solving it is to create more of these artificial support mechanisms, like the extra grants and those sorts of things, and more home builder stuff, or more first-time grants. But what you're doing there is basically just extending and pretending for longer and creating a bigger bubble later, and that bigger bubble will pop at some point, which just creates a bigger problem later. Unfortunately, that's the route that we're going down, and that's why I'm quite passionate about this, and the fact that the truth is, I think that we should be thinking of property in a different mode rather than just continuing to perpetuate the growth over 30 years. And just remember, long term, there have only been two periods in history where prices have overperformed relative to the inflation, just after the Second World War and in the last 30 years. So this isn't normal. This is absolutely abnormal.
Well, that's a point that Robert Shiller has made at length since the financial crisis. You know, the real returns of property really aren't all that fantastic. And that's something, that he's done. He went through over a century of data in the US, and that continues to be the case. And I mean, I do hope that we do see a significant change in the way that we do approach property, but I'm not entirely sure that we are going to see this big push from the government at a really big cost. Now, sure, first homeowner grants, all the things that we've tried and they've successfully done before. Yeah, sure, I could see them doing that. But when it comes to stuff beyond that, when all the chips fall and everything is just revealed, the curtains pulled back, when all of this stimulus is finally passed through the system, and we can really start to assess the global economy, not just the Australian economy, but the global economy for where it's really at. I think that the government's going to be faced with a really, really interesting dilemma, and that's something that we've been talking about now for probably 4 or 5 months, maybe even a bit longer, to be honest. And what do? Do they save the property market? Do they save property prices? Or do they go, this is looking pretty dicey at the moment. Are we just going to save our powder, save the things we need to save, like the banks, but let property prices slowly decline, and then maybe if the economy picks up, we can do something to help them later on, rather than throwing the kitchen sink at things and just
Yeah. Well, my point there would be that the election. I mean, the budget on Tuesday will contain some additional measures, I'm sure, to support property and support property purchases. I mean, they also talked about infrastructure, although actually I'm not sure that the manufacturing element of that is that huge, but we'll see. So there's a short-term thing, but there's also a longer-term question, right? The longer you keep this going, the more that you actually essentially let the the situation just keep bobbling along, with more and more economic activity attached to housing, you are creating a bigger risk for the broader economy later. And that's the thing that I think we have to come back to, right? So whilst we can worry about trying to protect property prices short term and protect the banks slightly longer term, unless there is actually a sea change in thinking, then we're not going to get the foundations laid for a broader economy, as we've discussed before, and we just keep saying that, but it's very important to underscore that. But the other point there is, in the meantime, we're going to create more casualties, and the risk that I see is that people coming into property late, particularly where property prices are now, if they're buying now, they could well be buying towards the top, and that means there's very little wriggle room if prices do go the other way. And unfortunately, think of them as cannon fodder in the crossfire of the political debate, in my view. That isn't necessarily a very good outcome for those individuals. Neither is it very good for the country. And at the bottom line, therefore, is that we need a different path.
No, I think you're right. But on the issue of the government, I think that I actually disagree. To be completely honest with you, there's this.
We have an argument. Yay!
People have been calling for it. So here it is, folks. No, I actually disagree, because the thing is, looking at things from a binary perspective, yes, the government doesn't want housing prices to fall. Absolutely, that's true. But by the same token, the Liberals are seen as what would you call them, the guardians of high housing prices after the last election.
The better economic managers.
Exactly. So if we do see the sort of similar falls that we saw between March and June in the ABS numbers of sort of 1%, 1% per month, maybe 0.5% per month in the other capitals, that's not that big of a deal. That's very similar to what we saw between 2017 and 2019. And the next election is about 10 and a half, 11 months away on paper. So realistically, they could potentially only see property prices drop 5 or 10% by then, which isn't too bad. They can just sit back and say, it's okay, things are going to get better, but think about how much worse it would be if Labor was in power. They might get rid of negative gearing. They might cut the capital gains tax incentives. They might, get rid of your franking credits, and think of what would happen to the share market. They're already having enough problems. Think about what happened last year. All those narratives are going to play into things. And I don't think that there's that much political cost for the government to just sit back and do nothing, realistically. I mean, in the short term. Now, if we're talking about them going a full term until May 2022, it's a very different story. Then you're talking about sort of property prices down, 10, 15, 20%, and that's obviously a much, much bigger problem. But less than 12 months from now, if they can keep a lid on the declines, which, considering the fact that we're going to have mortgage deferrals until March next year, and maybe even a little bit longer, and they're also a potential extension to JobKeeper, I think that they could probably keep a lid on property prices falling, to be completely honest with you, up until then, and just extend and pretend some more, and then get elected for another 3 years. And by the time the 3 years are up, they can just hope, hey, hopefully the economy would have improved by then and property prices will be rebounding, and then they can take credit for that and the rebounding economy, and then hopefully for them get another 3 years in office.
Yeah, well, it's certainly a feasible scenario. All I would say is that isn't going to help affordability for new people trying to get into the property market. Remember that the proportion of people owning their property outright is falling, the proportion of people who have a mortgage is rising, and the proportion who are renting is rising, right? So that would actually essentially just continue that same trend. And I guess there's a broader question, maybe as we come to the end of this conversation, which is, what do people want, right? Do people want to see property prices staying high so that effectively their wealth is protected, despite the fact that it basically makes it harder for other people to get into the market? And at some significant cost, because the government will be throwing a lot of money into it, and that's taxpayer money that could go somewhere else? Or do you prefer to take some of the pain now and see prices beginning to slide a bit, and then moving on to a more even keel, and perhaps focus on other areas of investment for the future? I mean, that is to me the big dilemma that I think is faced. I reckon that if you do the rule of numbers here, there are more people who would prefer property prices to stay high, all those who own property, and all those who own property without mortgages, as well as those with mortgages, which is 2/3 of the population. So there you go. That's where your majority is. So no surprise there, really.
There's not. I mean, I think, obviously, purely in terms of numbers, that's always going to be the case. But I also just think it's a case of how much is it going to cost versus what is needed by the productive economy. Now, don't get me wrong. If we're wrong about the severity of this, and we're wrong about the duration of this, and the Morrison government does decide to throw the kitchen sink at the housing market, and these irresponsible lending laws are passed, then sure, property prices could rise. Property prices could go to absolutely stupid levels, even more stupid than we've already seen. It's possible. But by the same token, if we are right about this, if the global data that we are seeing right now showing, Japan slowing, Europe slowing, issues in the US with enormous levels of layoffs and still 25.5 million people unemployed. Now, if that is the narrative that's correct, the government has a really, really big decision on its hands. What does it do? Does it pump all this money into the property market in the hopes of keeping prices high, when the political cost of them doing nothing for at least a short period of time isn't all that high? Or do they save the powder and just and save it to save the productive economy? If this does become a long protracted affair, the tourism industry is going to need to be saved. We're going to need to save, restaurants, hospitality, theatres, cinemas, all the arts sector. All of these different things are going to need to be saved in the long run once JobKeeper's gone. Or are we just going to keep JobKeeper forever? But either way, it's going to cost an absolute shed load of resources. So it comes down to that fundamental question, and we'll find out to a degree next week. If the budget doesn't show a huge number of new incentives towards the housing market, then perhaps I'm right, and if it does show a huge number, then I'm completely wrong.
Well, we'll see. I reckon that the total deficit will probably be, in total sums, up from 850 to close to $1 trillion, or probably over that, over the medium term. We'll also be able to look at the employment and unemployment projections that they actually run. But I will be watching the migration statistics, because I think that'll be a very important leading indicator in terms of what people are really, really thinking. So I reckon we should probably do another show after the budget, and we can then get a better read as to where this is likely to go. But I think we've marked the card a bit for next Tuesday. So let's see what they do with regard to the property sector. Let's see what they do with regard to other investment strategies. Let's see whether there's anything new or whether it's the same old, same old. And then we've got a better read going forward. But I do think that the deficit will be bigger, way bigger. And the trouble with the deficit is you can go on keeping it big for some time, even with low interest rates. But eventually, somebody's got to pay somewhere down the track, haven't they?
Well, you'd think so. But we're not really seeing that in a lot of places. In the US, they're saying, well, let's just run it up to trillions upon trillions upon trillions of dollars. But it's going to be interesting. I have a feeling, though. I have a feeling that the budget might be a little bit rubbery on some of these figures, because if the government says that net migration is going to be weak, and if the government says that unemployment is going to be high, and then they do crank up the immigration taps, and they do say growth is going to be weak, and then the immigration taps are turned on sometime early, sort of the middle of next year, it is possible for them to just say, look at how well we've done. Look at these GDP numbers. Aren't they fantastic? And that's something that you could really see them potentially using heading into the next election, which could give them a lot of political traction in terms of saying, look, we're superior economic managers. Treasury said this was going to be a disaster, but it's less of a disaster because we're so fantastic.
Sounds like the political plot. I like it. That's clearly how they'll be thinking. So what you're basically saying is expect this budget to paint the worst possible picture that you could ever think of, right? This is the low point, and then we can outline all the things we've done, and magically we'll pull ourselves back up by our own bootstraps, and everything will be wonderful, and then we can claim ourselves as being the best economic managers once again. Oh, well, now I understand the plot.
Master of the announcement effect, mate.
Very good. Well, Tarek, I appreciate your time today. That's been a really interesting conversation, and we covered quite a lot of ground. But I think it's good to contextualise the housing in the broader context, because you can't look at it in isolation, although it's a critical part of the picture. So thanks for that. We'll compare notes after the budget, and I'll look forward to our next chat.
Yeah, no worries, mate. I'm looking forward to it.
Okay, take care. See you later.
Sorry, mate.
Thanks, Martin North, Digital Finance Analytics, signing off. We'll see you next time.